Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris. Digging Deep is the show in which we look back at the week's news and try and dig a little bit deeper into some of the key stories. Joining me this week is David Erfle, Junior Mining Junkie. David, welcome back to Kitco.
Thanks again for having me, Paul. Always great to talk to you.
Likewise, David. And before we start, our gentle reminder that what we're talking about today is not investment advice and the opinions expressed are our own and not Kitco's. David, a lot of things to go through as usual. Wallet Wednesday this week with more than $1.2 billion in financing announced. We had Cameco announcing a $500 million debenture offering, Hudbay Minerals a $300 million bought deal. IAMGOLD did a $300 million bought deal as well. Patriot Battery Metals announced a $75 million flow-through financing. Solaris Resources a $35 million bought deal. And Faraday Copper a $20 million bought deal. David, it seems the financing window has finally opened.
Yes, as the gold price rises, the finance window has finally opened. And more importantly, some of these terms are getting more friendly for the companies as opposed to being more banker friendly. They're not having to give, some of them are not having to give out full warrants, and especially 2 or 3 years out, warrants that are 2 or 3 years out. The one that stood out to me the most was the Faraday Copper bought deal. That stock's been on my watch list for a while. I really like the company. The deal was at market with no warrants, and the share price actually went up on the announcement. So you rarely see stocks go up on bought deal announcements recently, but that has changed recently, where we're seeing at market bought deals without warrants. The announcement is being bought by the market.
Well, for people that don't know, let's perhaps explain what a bought deal is and why that's often preferable to a normal private placement financing. David, what is a bought deal?
Well, a bought deal is where you have the you know who the people that are going to take the deal are going to be. They're usually strong. They're strong shareholders, and it's not private equity. So private equity, the hands aren't usually as strong. So the participants are usually gonna sell the stock once the 4-month holding period is up, especially if there's going to be a warrant attached, and they'll just strip the warrant. So in a bought deal, it's much more positive for the company, and participants are much more stronger handed.
Okay, I want to dig a little bit deeper into some of the specific financings that were announced or have been announced this week. After 4 months of review, Solaris Resources backed out of a $130 million strategic investment by China's Zijin Mining. Zijin was looking to take a 15% equity stake in the copper gold explorer in Ecuador. Solaris, it said, it did not attain approval for the investment fast enough from the Canadian authorities. And it said it means the transaction no longer adequately reflects its value in the marketplace. The copper price has increased about 30% since that deal was struck. Zijin was going to pay a 40% premium at $4.55 per share. Having backed out of that transaction, Solaris subsequently announced a $35 million bought deal, as we mentioned, at $4.90 per share. David, is it odd that Canada dragged its feet on this particular transaction, given that Jintai Gold's takeover of Equinox Resources went through without a problem just the other week?
Well, not really, being its critical metals, because Canada's government has recently has taken a tough stance specifically on investments from China in critical minerals like copper, graphite, and lithium. In 2022, the Canadian government proposed beefing up its foreign investment rules to give power to block critical investments that pose a threat to national security. So in 2020, between 93 and 2023, China invested $21 billion in Canada's mining industry, but Canada's ordered Chinese companies to sell their stakes in 3 Toronto-listed lithium firms since then. I mean, earlier this year, the Canadian government asked a graphite miner, SRG Mining, to call off a planned investment from China's Carbon One New Energy Group. So it's really not surprising.
Okay, so that's really about the copper aspect then. Now, Solaris mentioned in its news release how its share price has changed. The value of its shares has changed a lot since it announced the Zijin financing at the beginning of the year. So it does seem also that there may be Canada's tardiness was perhaps a pretext to break off the deal and then do a financing at a higher price, i.e. less dilution.
Right. I mean, but the market sees the company getting 35 million as opposed to 130 million, and the stock sold off on the news.
And also, I imagine that Chinese companies are out there looking to buy copper projects, and so would this potentially close a door to Solaris in terms of its future financing and potential future partner or company to sell it to?
Well, as far as Chinese firms are concerned, yes.
IAMGOLD announced it's to raise $300 million via a bought deal of 72 million shares, priced at $4.17 each. With that, it intends to repurchase the 9.7% interest in the Côté Gold Mine in Ontario from Sumitomo Metal Mining, its JV partner, to return to a full 70% interest. IAMGOLD sold the stake as part of a $340 million financing lifeline extended by the Japanese company at the end of 2022 as Côté faced cost overruns and delays. David, this sounds very similar to New Gold's announcement recently of a financing to buy back the participation it sold a New Afton to the Ontario Teachers Pension Plan. Both companies struggled with mine builds and had to sell assets to keep the wheels on. So it also seems to be another case of high metals pricing curing all development ills.
Yeah, absolutely. The higher the gold price is going, then these companies are scrambling to purchase the rest of their mines. Equinox Gold did the same thing recently when they bought out their partner. Orion Mine Finance's 40% stake in the Greenstone Gold Mine in Ontario for roughly $1 billion in cash and shares just before pouring first gold there. So with the gold price appearing as though it's going to average over $2,300 in Q2, mining margins are set to soar after the gold price averaged just below $2,100 in Q1.
Well, as you mentioned, Equinox has just poured first gold this week from Greenstone. Congratulations to them. Now, with these mining companies buying back participation in their development assets that are now in production, and as you say, going into a higher gold price environment, with New Gold and IAMGOLD both now effectively right-sized, how attractive do you think they are as M&A targets?
Yeah, I think they're both attractive M&A targets. The Côté mine that IAMGOLD has just completed is one of the largest gold mines constructed in globally in North America in the past few years, and it's dwarfed the recently constructed Magino mine in scale. But the company has over 900 million in long-term debt and two other high-cost mines in Essakane in Burkina and Westwood in a more favorable jurisdiction of Quebec. So if a major were to target IAMGOLD, I would believe they would probably want to sell the other two assets. But in New Gold, and ironically also Renaud Adams is the CEO of IAMGOLD, is a former CEO of New Gold. New Gold has two major mines, that New Afton and Rainy River. I believe they're two long life mines in top tier jurisdictions, and their all-in sustaining costs are coming down. The 2-year average all-in sustaining costs of both mines together is around $1,700, but that they're on the eve of a transformation that will morph into lower cost producing mines with significantly higher cash flow margins. So those two companies, those two mines, I think would be more attractive to a major.
And of course, New Afton has a copper kicker as well. Côté IAMGOLD is expecting to produce around 500,000 ounces a year during its first 6 years of an 18-year mine life, with an all-in sustaining cost of around $1,000 an ounce. That potentially is a very, very big margin there. I'm not very much of a uranium person. I know you're not, David, but I want to talk a little bit about the Cameco financing. $500 million via a 4.94% senior unsecured debenture maturing in May 2031. The proceeds of that are to retire an outstanding 4.19% senior unsecured debenture due in June this year. David, Cameco is pushing out its debt for 7 years into what presumably is a higher uranium price environment. So it looks very much like they want to keep their cash for something else. What are your thoughts on this?
Yeah, again, you would think it's M&A. I mean, the uranium space needs M&A, more M&A, just like the precious metal space does. I mean, there's only so many checks these banks can write. These companies, these major miners, they need to add more. They need to add more pounds in the ground in uranium's case. So I would imagine it's going to go towards another acquisition.
Okay, well, time will tell, I suppose. Talking of bonkers numbers, somebody has out-Friedlanded perma-copper bull Robert Friedland this week. Former Goldman Sachs trader and hedge fund manager Pierre Andurand told the Financial Times that copper prices could reach $40,000 per ton at some point in the next few years. Yes, that's a 4 followed by 4 zeros, or $18 per pound in old money. Andurand's figure makes Friedland's $15,000 per ton estimate look timid. The metal has risen almost 20% this year, reaching a record $11,000 a ton. So he's looking at potentially almost a fourfold increase in the copper price from already record levels. David, what do you make of that?
Well, that's kind of along the lines of people going out there and predicting $10,000 gold. While I wouldn't brush it off as being insane, I like to be more practical, and I would be happy with a solid $5 per pound floor in the copper price. That's what we need. That's what producers need, and I think that would really kick off the M&A in the space even in more. I mean. The copper space has the same problems as the junior mining space. There's just too many of these little companies, and there's only so many checks that these banks can write. So we need consolidation, and the majors need to add pounds in the ground. I mean, more of these mines need to be built, and I think consolidation is very necessary.
Well, one thing I think, David, modern life, as we know, it would break down if copper got anywhere near those sort of levels, as all the criminals in the world would pinch all the power cables. They'd do a number on electric vehicles, and they'd be ripping out your AC units from the wall. It wouldn't be very pretty, I don't think.
Yeah, I tend to agree with you.
Okay, let's change track a little bit. This week, I attended the SME Current Trends in Mining Finance Conference in New York, and I sat down with a couple of people of interest. Firstly, with Jeff Christian of CPM Group. Jeff said many things during our conversation, as he always does. One thing that's perhaps very relevant to you, David, or what I really want to get your views on, he said that, the CEOs of most mining and exploration companies have long assumed that sooner or later their share prices will catch up with the hot pace set by metals prices. But Jeff is not so sure that this will happen. He said there's been a divorce between equities and the metals prices. And he said that's here to stay as investment fundamentals have changed. Specifically, he said that actively managed funds and stock picking has largely been consigned to the past, with the accent of exchange-traded funds and index instruments. And now there are very few humans who are actually out there bidding up prices. David, you're a human who's bidding up share prices. What do you think about this? Do you think stock prices have divorced from the metal prices?
Oh, it's obvious. Yes. I mean, if you take a look at the GDX, it's 40% lower than when the gold price hit a peak at 1925 in 2011. So that divorce has taken place. The divorce began when the bear market began in 2013 in the mining sector, when the gold price lost 1550 and the bottom fell out of the sector. We got all the way down to nearly $1,000 gold. And if you take a look at the HUI gold ratio, which is something that I follow very closely, it got down at a level that was the stocks became the lowest valuation in relation to the price of gold, basically in history. And we recently tested that level again several months ago before the gold price broke out. So you had the gold stocks trading, the cheapest they'd been in history with a gold price double of what it was. So absolutely. And I think a big reason for that is you've got a lot more competition now than you had back in the last bull market from 2001 to 2011. You've got competition in Bitcoin. You've got competition in AI stocks that have taken a lot of the speculative money out of the sector. So, the mining shares, they bottomed in October of 2022. They've been, the sector's been making higher highs and higher lows since then. And I know it hasn't seemed like it, but that is the case. But the juniors have lagged horrifically. But we have started to see a lot of bifurcation recently after the silver price broke out above $30 an ounce. That was strong resistance, because if you take a look at the chart of the silver price over the past decade and the GDX and GDXJ, those charts look very similar. So the silver price and the gold stocks, especially juniors, have been lagging the gold price. But if you take a step back into the big picture, you've got this huge symmetrical triangle being formed in the GDX. Higher highs, higher lows, consolidated inside 13 years, and once it breaks out above 36, which is trying to do right now. It ran up to 36 on Monday, and you're seeing some healthy profit taking because it got extreme overbought. So a monthly close above 36, I think, will get a lot of people more interested in the sector, and also we need to see speculation coming out of AI stocks, which we're starting to see this week also. I know NVIDIA had another blowout quarter, but it was a standalone issue. Other AI stocks are starting to sell off as the market is fearing higher for longer interest rates.
What are your thoughts, David? Is this divorce a decree nisi or a decree absolute, to use UK divorce terms? Is it a temporary thing, or is it going to be a permanent divorce?
Well, I think it's going to be a permanent divorce for many juniors, and it needs to be, because going back to this to the issue of there being too many juniors, and we need consolidation. There's just too many lifestyle junior companies out there. In the past, we've had these bear markets in the mining sector, and then once the finance window opened, we had these huge moves. But recently, as we talked about at the top of the discussion, the finance window is being opened again, but not for everyone, because capital is no longer cheap, right? I mean, I've been in this sector for over 20 years now, and during the previous bull markets, capital was cheap, and banks were handing out capital willy-nilly to just about everyone. But now that's not happening anymore, which I think is a good thing.
Now, David, having recognized this trend, this pattern, this divorce, as an investor, how do you play that? Do you reprice your assumptions and your targets, or what else do you do?
Oh yeah, I mean, it's you really have to be stock specific. It's still a stock picker's market, and you just have to make sure that you pick the right juniors. And I've pretty much stayed away from early stage exploration over the past few years, because there's really no need to take on a higher risk position in a company that's looking for something, when you've got all these other companies that are de-risking projects they've already found, and they put out positive economic studies, and they're at the finance stage or close to the finance stage. They're looking for strategic partners, or they've got strategic partners, and they need to put together a financing package. And we're starting to see these financing packages are coming to fruition. But before doing that, many of them had to dilute their shareholders a lot by the time they got there. So the companies that were, the stocks that were maybe 8 to 10 baggers a year or two ago are now maybe 3 or 4 baggers because of the dilution. There's still nothing wrong with 3 or 4 baggers, but when you're in a high risk sector like this, you want 3 times to 10 times upside in these stocks before you take a position in them. So it's really interesting how this is going to play out going forward as the gold price continues to rise, which I expect it to do.
Okay. Another person I sat down with this week in New York was Rob McEwen of McEwen Mining, and we talked about many things, one of which was the company's 270% share price increase since Rob did the initial funding for McEwen Copper, which is going to be spun out at some point in the future. That was back in 2022. I asked him about, 270% increase is very, very good, and also head and shoulders above a lot of his peers in the sector. So I asked him about the ability or the possibility of the company using its stock as leverage or currency for deals into other assets. And of course, he gave me his game face, which of course I'm going to interpret as a yes. David, should we expect McEwen to do deals with its stock riding so high?
Oh, absolutely. He still has this dream of becoming only the second company to be listed on the S&P 500. And to do that, he needs to grow. That dream was almost dashed a year or so ago when the share price was threatening to get below $1. They did a reverse split to keep it above $1, and the share price has been moving up ever since. So the stock has been doing really well. And so I would absolutely expect him to do that.
Okay, David, let's end with a drill result. What have you got for me?
Okay, there's a company that you and I visited, a project that you and I visited in October of 2022, Vizsla Silver, and this week they reported results from 16 new drill holes targeted at the Napoleon vein. They've got several veins at high grade veins at the Panuco project. And the highlight of that drill program this week was over 2,500 grams per ton of silver equivalent over 2.4 meters. So these new drill results are part of Vizsla's fully funded ongoing 30,000 meter resource conversion and expansion drill program at Panuco. So, this is a company that has 40 million in cash. They've got a large, fully funded drill program going on. They keep hitting this high. You can't sling a dead cat without hitting high grade at Panuco. In January, they released an updated mineral resource estimate of over 300 million silver equivalent ounces, and they're going to be releasing an initial PEA on the project in Q3. Although the stock is attempting to break out of this two-year base, and it's moved up quite a bit in recent weeks, it's still only valued at $1.20 an ounce of silver equivalent ounce in the ground. And it's arguably one of the best silver projects owned by a junior. I mean, I am biased because after we did that site visit, I was very impressed, and I purchased the stock and recommended it to my subscribers.
David, I mean, that's an interesting because primary silver deposits are very rare. They're, rarer than, hen's teeth, as they say. Why silver's moved above $30 an ounce? I think it touched $32 per ounce this week. Why is that not really being reflected in the share price of some of the leading junior explorers?
Well, it's starting to now. I've been saying for several months now that the juniors, I don't believe the juniors will really start to get going until silver has a strong $30 floor after the gold price has now made a strong $2,000 to $2,100 floor after being 13-year resistance. Well, that resistance at $30 has been resistance for over 11 years in silver. So it made a 11-year high recently, and that has taken place. We've seen silver juniors really start to take off. If you take a look at the SILJ, that's the silver junior ETF. It's not only leading the gold price, but it's leading the silver price, and it's leading the miners. So, recently we've had the miners and silver leading the gold price. And now when you have the SILJ, the higher risk silver junior ETF leading everything, that's very bullish for the sector. So I expect that these silver juniors will continue to outperform. They've remained in their uptrends even after this profit taking that we saw coming into the sector this week. So the silver price came down and tested that $30 an ounce breakout this week, and I expect the silver price to continue going higher after that.
So potentially some fireworks to come in the silver space.
Absolutely. Yes. I mean, I've been saying that to my subscribers ever since the beginning of the year, that the silver space was the place to be this year, because once that $30 level gives way, we get a $30, we've had a $30 close on a weekly basis above there. On a monthly basis, it's a lot stronger. So if silver is able to close above 30 at the end of this month and in a couple of weeks here, that'll bring much more investors into the sector, I think.
Well, that's perhaps a good cliffhanger to leave our viewers with as we end. Watch for the silver price to continue going above $30 per ounce. David, it's been wonderful. Thank you very much for joining us today.
Thanks again for having me, Paul.
And that's all for me. I'm Paul Harris, and this is Kitco Mining.